Hey everyone, today on the final bar, we'll talk about a resilient market that just seems to keep going higher. Most of my guests this week talking about, long-term weakness in the market, with the market, leaning back toward lows with a bunch of different methodologies. But if today is any signal of where we're headed, we just keep tripping higher, led by energy. So we're going to break down that leadership theme with energy. And today on Wrap the Week, we're really going to focus on the long-term charts and how they've evolved. Ladies and gentlemen, this is the final bar. Hey everyone, welcome to today's edition of The Final Bar. I'm your host, Dave Keller, the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close. Look at the market activity through a technical lens, try to connect the short-term movements of today with the long-term trends, understand what's working and what's not. And there's no better toolkit, in my opinion, to doing that than using charts, visualizing market activity, visualizing supply and demand, fear and greed, looking at the charts together and trying to anticipate where we're headed next. And as I mentioned, first off, we have this situation where there's this huge disconnect between the economy. We had one of the worst job reports ever today, continuing this, unprecedented amount of job losses with a market that continues to go higher. So there's a disconnect between the market and between the economy. And that makes sense given the situation that we're in. We're having huge economic challenges due to the economic shutdown, states trying to reopen over time, but the market goes higher. And again, the market is a voting machine in the short term. So this is investors suggesting that at least the worst is behind us in terms of the potential for upside as we recover. So we're going to try to see how the charts make those themes a little clearer over the next 30 minutes together. We have some fantastic guests on Stock Charts TV. This week has been wonderful with some of our guests. Next week is no different. So on Tuesday, we have Roman Bogomazov from Wyckoff Analytics. On Wednesday, Sam Stovall from CFRA Research, and then Tom Boley from Earnings Beats is going to join us on Thursday the 14th. Two other shows I wanted to point out to you. On Monday the 11th, we have our next episode of Behind the Charts. That's our interview style show, and we sat down with Keith Fitzgerald. Keith is a fantastic thinker and strategist about the markets, and we had a great discussion about how he approaches things and really about the behavioral mental game of investing. So I think you're really going to enjoy that conversation on Monday with Keith Fitzgerald. On Wednesday, our last thing is our latest episode of The Pitch. This is our new sort of monthly program featuring a Stock Charts moderator and then 3 guest panelists who pitch you their ideas. And then we use the charts to debate those as a group and talk about where we see things headed. So Grayson Rose from Stock Charts is going to host that. And then we have Aaron Wood from Decision Point. We have Dan Russo from Chaikin Analytics, and then myself from Stock Charts. The 3 of us will be the panelists talking with Grayson about our pitches, our ideas for the coming weeks and the coming months. You're not going to want to miss the pitch. It was a really, really cool first episode about a month ago, and here's our second attempt next week. Let's get to our market recap. So, again, there's this huge dichotomy in the markets right now between where I think a lot of investors think the market should go based on the situation that we see around us, companies, and as they report earnings, you can see the destruction that the coronavirus and social distancing and everything has had on a lot of people's business models. I think nothing is really going to be the same as it was before, and companies are trying to deal with that and anticipate what sort of a reopening of sorts that the economy will have. But you take that with what the market is doing, and even though a couple days this week, you really closed lower, and last 2 days, really, you had this, distribution going into the close. So the second half of the day felt more bearish than bullish. But then you have a day like today, last day of the week, and it was just sort of a long and strong gap higher, and then just continuing up further with the S&P up 1.7% to close just under 2930. That's another big upswing. So again, it's this disconnect between negative news and positive markets. And again, given the news and the markets, you have to follow the markets. And that tells you where people are voting with their feet, where they're voting with their capital, where they're making their bets, and investors are betting on the market going higher. I think no better way of illustrating that today than looking at the performance of mid caps and small caps. So mid caps up almost 3.5%, small caps up over 4%. So this is certainly more of a risk on, step on the gas. I think things are going to get better type of move. It certainly seems like. Looking at some of the sector leadership, and then we'll look at a chart of the S&P and some other themes. Energy number one. So you've had this continued move of oil prices increasing, of energy stocks doing better. If you look at different sectors, you'd be hard pressed to find something that's done better on a relative basis over the last 6 weeks or so than energy. Some of those big energy names have recovered 20-30% on a relative basis out of the market low. So the XLE up 4.5%, followed by industrials and materials. We always call that the MEI trade, materials, energy, industrials, sort of the late cyclical leadership. And that's really what led the way higher, followed by consumer staples, notably number 4. On the bottom, which is kind of interesting, you have healthcare and technology. So some of these sectors that have been bellwethers through this whole experience, all of a sudden not getting as much of a bid. They're sort of at the lower end, underperforming the S&P today, while some of these other groups, energy, industrials, materials, leading the way higher. The VIX actually down and below 30 now for the first time in quite a while. We haven't seen a VIX this low in quite a stretch here. Here's a chart of the VIX. You can see the reversal that it's had. Talk about a V bottom in stocks. Flip this chart over and you have an incredible V bottom in volatility. And that's actually pretty normal. The VIX usually doesn't have this big, turnover when it gets to the top because there's panic, and that's what accelerates volatility to the upside. And then when people get over it, they get over it pretty quick, and you come back down here. So right now we're below 30, which now puts us well below some of those previous extremes, and not really the big market sell-offs, but now we're below where we were in like 2015, 16. The 18 and 2019 lows were all with a VIX higher than this. So we're now back in sort of approaching more of a normal range for the VIX, going back for the last 10, 15 years, which is interesting. It's amazing how quickly that volatility has subsided. And if you look at the movement in the S&P, I just noticed today it felt like a huge move. It's like a 1.5% gainer. There was a stretch there where we were seeing 4, 5, 6+% moves every day. So we've certainly felt that volatility come back. And again, it's more of a normalizing of market activity, which overall is probably a good thing. It makes a little more sense, I think, to a lot of investors. Here's what a daily chart of the S&P looks like. And again, what we've talked about, I don't think the pattern overall has changed. I think it's still the thesis that I'm seeing. And over the weekend, as I do my weekly review, I'm kind of going to spend some time digesting what we saw this week, because it was certainly, last week at this time, it felt like, okay, we've now seen the beginning of this next leg down. All the charts just in 1 or 2 bars start to look a lot less positive. But look at how we've just turned right back in. We found support around S&P 2800 and now have come back up. And now, again, we're reapproaching that, what I would consider the ultimate line in the sand for the S&P. It's that 2935 to 3,000 level. That's between the Fibonacci resistance and the 200-day moving average. I would be really amazed and shocked if we don't, find at least more of a meaningful top in that area than we have already. Which is why it felt like the top about a week and a half ago made so much sense, right about at that sweet spot. So if and when we break above 3,000, I think you really have to question the bear market rally thesis, which I've been thinking about for a while now, and question something else. I had an interview yesterday and was asked about, for the Financial Sense podcast, I was asked about divergences. And to be honest, there really aren't a ton. I talked about financials breaking down as maybe the one that comes to mind, but it's not like you're getting a big RSI divergence like you would at previous highs. It's more of a constructive RSI, just not yet in that bullish range, which is what is potentially a bit of a concern there. So overall, an interesting follow-through day, certainly a move to the upside. Let's look at some of the other markets before we get to our weekly wrap here. Looking at the fixed income side of the markets, the TLT actually down about 1.3%. So this is certainly stocks over bonds today, and that ratio has certainly favored stocks now, especially on the recovery out of the lows. We'll look at that chart here in a moment in our market recap. This has pushed the 10-year yield back up to about 68 basis points, about 0.68%. Commodities pretty good today, with oil leading the way higher. The DBC, a commodities ETF, up over 2%. Gold was really the only one that was significantly down at 0.6%. That's not true. Natural gas down 4%. But in terms of the common ones we tend to follow, the relative safe haven of gold down a little bit, about 0.6%. So let's go into our next segment called Wrap the Week and really think about what this means. What we love to do for this part of the weekly journey together is use the Mindful Investor Live chart list. If you've not accessed this before, pretty easy to find. Click on the articles tab on the top of StockCharts. Go to my homepage on StockCharts, which is click on the blog listing, and go to the Mindful Investor, and you will see my page with some of the articles I've written. Live chart list is going to take you right to this this place, and you can follow along as I make tweaks to it. It'll update on your side and give you a sense of where things are coming from. So we're going to start with what I call the market trend model. This is something I've followed for a number of years, and it's essentially using weekly data, and it's looking at the 21 and 34 week exponential averages. I actually had a great, deep, philosophical, at times heated debate with our founder, Chip Anderson, earlier this week, and actually it's been an ongoing debate for a while about moving averages, and I tend to use simple moving averages in general. And if you look at my charts, it's the 50 and 200-day moving averages, because I sort of subscribe to the self-fulfilling prophecy thesis. I've met so many institutional investors that look at the 200-day moving average. So I want to know where the 200-day moving average, the simple moving average, is, because I know so many investors that are managing plenty of money are seeing that and are reacting to it. Chip is arguing more from the side of using exponential moving averages, because in general, they're a much better way of actually tracking price movements, and he's not wrong. I don't disagree with that at all. And so it's not a surprise. I sort of told him, I reminded him that my long-term trend following model is built on exponential moving averages because of that fact. I think, if you compare the two, there's no denying that it's a better way of tracking it, because it's weighted more towards recent price history, which means it's going to be much more reactive. When the market moves, the exponential averages are going to fluctuate. So there's three pieces here. There are the long-term moving averages, which really the weekly PPO shows you the difference. It's been below zero since mid-March, remains negative. The medium term is the weekly PPO using the traditional 12, 26, and 9, sort of the weekly MACD that most people would follow. And this is so close to giving a buy signal, but has not quite done so. So it'll be interesting to see if we do get a buy signal in the next week or two. We'd have to rally a little further to push the moving averages up a little bit, but getting very close to a potential buy signal there. And then the short term, the tactical period that I look at, was sort of a couple days to a couple weeks, is using the histogram on the PPO, the change in those moving averages, and that turned positive sort of late March, beginning of April, and obviously tracking this short-term tactical uptrend that we've seen. So the model remains short-term bullish, medium-term bearish, long-term bearish. That medium term is getting close to switching. And again, this is not, I would not run a fund based on this as an algorithmic model, but it's more a bias with which I look at the rest of my charts. And I find looking at this often helps me just key on the long-term trend and make sure that I'm focusing appropriately. We already talked about the daily chart of the S&P, so I won't beat the bush too much, only to note that I would want to see a break above S&P 3000, getting above the 200-day, getting out of that resistance range. That's sort of the last line before I think you have to anticipate a return to previous highs or at or near 3,400, which sounds crazy to me still, but you have to follow the trends, and that's what the charts are telling you. That would also have to put an RSI above 60, which I think would be important as well. We've not seen that yet, and so at this point, it's still remaining sort of in that bearish range of oversold to not really getting above 60. That's sort of classic for a bear market phase. This next chart, looking at the cumulative advanced decline lines, this is one of our 3 and 3 charts yesterday, I want to say. And it's basically, another point, as the markets rallied so unexpectedly strong out of these lows, and I know talking with a lot of my peers in the industry, sort of just trying to make sense of how quickly this has reverted back to the upside. I always like to find some ways to try to qualify that and ways to anticipate when we might be getting an end of that rally. And I think for me, looking at the cumulative advanced decline lines on the S&P, the mid caps, the small caps is pretty good. And what we've seen is this continued pattern of higher highs and higher lows, just like the market itself. Small caps just tested that lower trend line. This is not updated for today, and so this is going to improve a little bit as we reviewed over the weekend. But I would want to see a break below that trend line. See these cumulative advanced decline lines start to break below a trend line using the lows, and then break below the most recent swing low. That would be sort of that confirmation that we're starting to rotate lower. We haven't yet, which tells you still that short-term upside is still in play. This is a long-term chart looking at new highs and new lows, new 52-week highs and lows. I'm going to zoom in a little because it's kind of hard to see the most recent data because it was so skewed. That's what I thought. It's still not a ton of stocks, still a rounding error of stocks making new 52-week highs and lows. If you think about it, the chart of the S&P is literally, 2/3 of the way back up through this overall thing, and that's about right. There are some stocks like Newmont Mining and Regeneron and others making new price highs, Activision, Electronic Arts, all of those. And there are some making new lows, but not many. And there are very few because most of them are in this range. And that's kind of what that indicator is sort of telling you. Going on to our next chart here. So we've gone through new highs, new lows. Our next one is looking at breadth in terms of the 50-day and the 200-day. You know, one of the things I've noticed recently is that we had almost 80% of the S&P above its 50-day, and that's up from 0 about 6 weeks ago. Came back down to the low 50s, but now back up to the mid 60s. So the way to think about half the stocks that broke back down below their 50-day have now popped back up and have recovered right back to where it was before, and in more of a positive trend above the 50-day. A quarter of S&P stocks are above their 200-day, which still means 75% of stocks are below their 200-day, just like the S&P itself is. You know, again, one of those broad indications telling you things are quote unquote getting better is this indicator getting back above 50%, which means over half of the stocks in the S&P have recovered, have reclaimed their 200-day moving average. You saw that in mid 2009, sort of confirming that the 09 low was the low. We're not there yet. Sentiment's an interesting one. If you look, excuse me, over 50% voting bearish in the latest AAII sentiment rating. Again, I'm not a huge follower of sentiment in the form of surveys. I think they're anecdotal. It's the same way I would follow magazine covers. I wouldn't trade based off of the Economist putting a certain bullish or bearish theme on the cover of their magazine. But I think it's interesting anecdotally to understand what themes people are interested in, what sells magazines essentially, right? And the same thing with surveys. I'd much rather follow price and see where people are actually voting with their capital. But I think it's worth noting that over the last 6 weeks, you've had less and less bulls overall every week that they've been surveyed. So less and less bullishness as we've gone higher. This is a really interesting chart here, and we'll just have a couple more before we need to take a break. This one is looking at the ratio of the XLY versus the XLP, so consumer discretionary versus staples making a new swing high again this week. And again, that's driven by Amazon primarily. And you can see that from the bottom clip, which is looking at the equal weighted consumer discretionary versus staple. So if you see the top panel moving higher, the lower panel has not quite made a new high. And that's because Amazon really driving the ratio higher on the upside. So overall, still not as much of a vote for strength there. And then the last one I want to finish off with is looking at the relative performance of small caps versus large caps. One of the themes that's been so beaten in my head, I feel like, analyzing these markets is the underperformance of small caps. And this is over the last year. You can see that, you know, the sell-off in stocks wasn't the beginning of that underperformance. It's been happening for quite a while. But if you look, it's just starting to really improve on a relative basis. You had that spike higher, pullback, and now rotating back higher. And again, on a day like today, when the S&P was up 1.5%, small caps, mid caps up 3-4%. And we're starting to see that more than we're not. And that's why that ratio is starting to go higher. So an emergence of outperformance in small caps, something I've been talking about for a while, is one of the challenges, one of the things we have not been seeing. If this continues to go higher, I think you have to start to acknowledge the fact that those higher beta groups are actually starting to improve just a little bit. That's our weekly wrap for today. Again, so many themes to think about, and a really fascinating part in market history, I feel like, as we've recovered so well. So hopefully some of these charts help to fill in some of the blanks in your own thinking. We're going to take a quick commercial break. Back opening the final bar, mailbag, and answering your questions. We'll see you in a minute. Hey everyone, welcome back to the show. This is your host, Dave Keller, here at StockCharts.com. Thanks for joining us every weekday after the close for the final bar. Momentarily, we're going to open up the final bar mailbag. As a reminder, we'd love to answer your questions on our next episode. So just shoot us an email, thefinalbar@StockCharts.com. We get a lot of really good, thoughtful questions. Send us a question, take a screenshot of a chart you're looking at, and we'd love to address it on the air. And again, the goal of this show and with Stock Charts TV is to empower you to make better decisions. And if we can answer your questions, help you a little along the way, we'd love to do it. Next question, or our first question actually here, opening the final bar mailbag. May I ask, flags and wedges trip me up because their higher highs and higher lows are bearish signals. Any advice on how to reconcile in my mind? Should I think about these as operating on different time horizons? That's actually a really cool question. Let me bring up a chart of like JP Morgan. And again, this may not be the most ideal flag, but it's something that comes to mind, right? So a bear flag pattern is essentially when you have a sell-off and then you have this parallel move of higher highs, higher lows, and it's a counter trend move. So think of this as wave one or wave A. This is your wave two or wave B, sort of a corrective move. And then sort of classic move pattern is you have another leg down and you take this parallel move of highs and lows, you break down through the lower end, and that suggests further lows. And this is why some of the banks, to be honest with you, in the financial sector in general, has looked more negative, besides the fact that the relative performance has been so bad. It's because of a lot of these bear flag patterns, I think, that have started to emerge. But your question in particular says, but isn't this bullish to have higher highs and higher lows? And as my wife often reminds me, I say higher highs and higher lows on this show a lot. And that's repetitive on purpose because I think it's such an important, simplistic, but valuable concept to keep in mind as you're looking at charts. And so I think your takeaway, I think you answered your question very well. And I think that's it. It's a question of timeframes. The way I think of my long-term trend following model, my trend following model is short-term, medium-term, and long-term. So in this case, the short-term trend is positive, and that's why it looks like a bear flag. The medium-term trend still weak. And so I think that's where the longer term cycle is kind of going down as it's below 2 downward sloping moving averages, as the RSI is in bearish range. Overall, if you look at a weekly chart, you might see a lower low, a lower high, and this is maybe making a lower low. But on the daily chart, it starts to look like highs and lows going more positive. So short-term trend positive, long-term trend down. When I think about multiple timeframes, this is the type of chart that makes a lot of sense. And if you flip this over, and if you have a chart that's been overall pretty positive, and then you have a bit of a pullback, more often than not, that ends up being a really good opportunity to build on a long position. So great question, and I think you're right. It's a question of time frame. Question number 2 and really 3. My guest yesterday, Clint Cowles from TD Ameritrade, is an Elliott Wave analyst. I had a number of you ask if I could incorporate more Elliott Wave into the show, and the short answer is no, because it is not a key part of my toolkit. However, yes, I will definitely agree to bring more guys like Clint on who are Elliotticians who can speak with authority on what they're looking at. So I certainly enjoy bringing guys like Clint on. I will continue to do so and bring others on as well to get their take looking at Elliott Wave patterns. A lot of your questions were about his count that he showed and what exactly he was looking at on the S&P. And again, his basic sort of thesis was that after this sort of counter trend move, the next leg is down. And he was basically seeing this as a big A, B, C correction, which would take us down here below the sort of viewable area of the chart. A lot of you sort of posed an alternate count and showed, isn't this the correct count? And so I would say this is one of the challenges a lot of people have with Elliott Wave, is that a lot of times people will have their preferred count, sort of what makes sense to them, and then they'll have like an alternate thesis that this could be the count. And I don't know if you caught it, but Clint actually mentioned something like that. He said, one of my alternate hypotheses is this, and he sort of illustrated this secondary point. You can watch the video again if you missed his comment there. He didn't get into a ton of detail, but that's what happened. So he sort of has a primary count. This is what it looks like, but it also could be this. And some of the examples that you guys sent me were similar to some of his alternate counts that he was showing you. So I think if you're not familiar with Elliott Wave, that can seem super subjective. And I think in some ways I hear you. And that's one of the challenges that I've had, and one of the reasons why I don't incorporate it as much into my own investing, because I think there's a subjective nature to it that I'm able to compensate for that with other tools. Having said that, he didn't get as much into the details of the measurements, and that's where a lot of Elliott Wave process becomes more rigorous, more statistically oriented when you take the lengths of certain waves. And it's not just what could be a wave 1 or wave 2, it's all about the relative measurement. So wave 2 should be X% of wave 1. And again, he just touched on that. But I think the guys like Clint that really know what they're doing and have used that toolkit deeply have a lot more justification for some of those wave counts beyond just what he was able to share in 5 or 6 minutes with us together. So thanks for sending some of those alternate wave counts. I think the things that you sent, for the most part, totally fair alternate takes on it. But again, from Clint's perspective, we're sort of at the end of that wave B before a wave C going lower, but then that's all part of a wave 4, and a wave 5 puts us to new highs, 34, 3,600, something like that going on. Next question, please discuss how to determine which scooter ranking stocks are top ranked because they will continue higher versus those that overbought short-term peaks that may be going lower. That's a really good question. I wish I could know, and if I did, I would sell the Dave Keller scooter fund that would only bet on those stocks that were going to continue higher. You've hit on one of the classic challenges with trend following, which is the scooter reports are not necessarily forward-looking. They're all based on the historical trends, right? It's telling you how strong the trends have been going up until this point. And the essence of momentum investing or trend following is that stronger trends will continue to persist. And that's on that time frame of, what I call the medium-term time frame, a couple months to a couple years. You have 3, 6, 12-month time frame. In general, the data supports being a trend follower. You should be betting on stocks that have worked and underweighting or not betting on stocks that have not worked, because that's the time frame where momentum and relative strength really test well if you go back through multiple cycles, multiple decades. Having said that, there is no guarantee that tomorrow the trend from yesterday is going to persist. What you're doing is you're betting on those trends overall to persist. And I think at inflection points when the trends start to reverse, that's where trend following can be very difficult. And that's why, to be honest with you, anyone that capitulated and bet on a further downtrend in stocks maybe missed the beginning of the V bottom, or at some cases people are not quite in the market yet because they missed that V bottom and they were betting on this long-term downtrend to continue. It may continue eventually, we're not sure. So, to answer your question, there is no way, unfortunately, to know which is which. That's why I would say scooter rankings are a great way to organize stocks into a meaningful order. And if you look at just the top 10 stocks and look at the charts, there are going to be a lot of similar characteristics, but they're not homogenous. They're not all the same charts. There's some different ones, some that are just making new highs, some that are coming out of broader bases, some that are not making new highs, but have just accelerated enough coming out of the lows that they're starting to grade pretty well on it. So I think a subjective look at the charts is the way to start to qualify. Using other tools in the toolkit besides just the scooter ranking is what's going to help you make that decision. So the scooter rankings or RSI or something like that should help put stocks into a meaningful order, help you focus on overall the best, most likely candidates to outperform, and then look at the chart, use some of the other tools that we have to try to qualify and anticipate what's going to continue. That's all the time we have for our questions. Again, thank you guys so much for sending in some very, very thoughtful questions. I summarized some very well described questions from many of you, and I hope my answers have been helpful for you. Please keep them coming. Happy to answer your questions on our next broadcast. We need to wrap the show though and go right to our 3 and 3 charts in 3 minutes. Here we go. Chart number 1, we talked about in our weekly recap, our wrap the week segment, and this is looking at consumer discretionary versus consumer staples. And again, at times this has moved in a similar fashion, the cap weighted version at the top, the equal weighted version at the bottom. And what's interesting is for the last 6 weeks, you've really, and even before that, you've seen the dominance of Amazon in consumer discretionary, how it skews the results a little bit. So it shows more strength on the upper panel than the lower panel because of the strength in Amazon. If you look at the bottom, we're actually starting to get a bit of a divergence where the upper ratio is increasing, the lower ratio is decreasing. And that maybe means there's a little more balance between consumer discretionary and staples if you take Amazon out of the picture, which is, I think, worth noting. Chart number 2 is really highlighting the potential for outperformance for small caps. I've been saying small caps have been underperforming for so long, it's hard for me to not change that phrase as it exits my lips. But the chart is starting to support the outperformance of small caps. Yesterday, we looked at cap tier performance. And if you start the clock at the February market high, the S&P 500 has been the top performer. Large caps have done better than mid caps and small caps and micro caps over that period from the February high. If you start the clock at the March lows, though, it's not large caps that have been the #1 performer, it's mid cap stocks. So small caps have actually started to do pretty well, and mid caps the same thing. So you're starting to get some outperformance from the lower ends. Again, whether that's able to persist, I think that's going to start to get people to believe more in the longevity of this uptrend that we've seen, that it might not just be a bear market rally, but something a little further that we have to be prepared for. And then the final one is looking at advancers, decliners, just looking at the percent of stocks on the NYSE that are advancing or declining. And I think it just caught my eye as I was reviewing them this morning that the advancers overall have been trending positive this week. The decliners have been trending lower. Today, we did not quite get a 90% update, which is a breadth thrust, a severe uptrend with so many stocks on the positive side, but it was 8 out of 10, closing higher today, which is pretty decent. So overall, you've certainly had participation on this uptrend more than what we've seen in the weeks leading up to this. That's our show, and that's our week for the final bar. Keep your questions coming. The final bar at StockCharts.com. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Have a great weekend. We'll see you next week.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.